Price behavior may seem random at times, but once you understand what's going on behind the scenes to make prices move, price behavior will make a lot more sense. So in this chapter, I'm going to introduce to you the principles of what moves stock prices, which is supply and demand. So if you're ready, let's get started. Pull up any stock chart and you'll see that the price doesn't move straight up or straight down, but rather in this wave-like action. And this wave-like action you are seeing is all based on how people perceive the current stock price in relation to how they think the stock should really be worth. If the majority of people think that the price is cheap or undervalued to what they believe the stock is really worth, then this will spark demand to own shares of that stock because they believe the price will be higher in the future. So let's say that most people believe the stock is valued at $14 a share and it's now currently trading at $12 a share. This cheaper price may entice more people to buy, which may cause enough buying pressure to push prices higher. But if the majority of people think that the current price is too expensive or overvalued to what the company is truly worth, then there will be less desire to own shares. So again, if most people believe the stock is worth $14 a share, but it's now trading at $16 a share, then this more expensive price may entice more people to sell, which may cause enough selling pressure to push prices lower. So when it comes to supply and demand, this is really all what it is. Demand is represented as buy orders. People place buy orders because they believe the prices will be higher in the future. And supply is represented as sell orders. People place sell orders because they believe the price will be lower in the future. And whenever a stock receives an imbalance of people wanting to place buy orders versus sell orders, that's when the price will move up or down. If there are more people eager to buy shares versus people wanting to sell shares, then it will cause the price to increase. Whereas if there are more people eager to sell shares versus people wanting to buy shares, then this will cause the price to decrease. But also, if no group is really dominant, where neither buyers or sellers are overpowering one another, then the price has reached equilibrium, where the price trades mostly sideways. This is just like the stock trading at $14 a share, where most people believe is the true fair value of the stock. So it's going to be this imbalance between people wanting to buy versus people wanting to sell that will determine the direction price will go. And our job as a trader is just to figure out what price levels these imbalances are most likely to occur at. What price levels are people going to find the stock to be undervalued and want to buy that will cause the price to rise? What price levels are most people going to find the stock to be overvalued and want to sell that will cause the price to fall? What price levels would buyers and sellers agree that the price is accurately valued and no group is really dominant where the price finds equilibrium and mostly trades sideways? And these questions right here is really what trading comes down to. Don't let anybody ever tell you it's more complicated than this because it's not. I think people love to overcomplicate things when it comes to trading, and a lot of people lose sight that simple supply and demand is what moves price. And if you can learn to read where these imbalances will take place, then it will greatly improve your trading performance. So I hope you all learned something, and I'd like to thank you so much for watching.